Bolt Automotive, and in this presentation, we'll be discussing our 7-year company reports. Next. These are the topics we'll be covering. Next.
Hi, I'm James Chen. I'm the CEO.
Hi, I'm Joseph Roglaski. I'm the Chief Financial Officer.
Hi, I'm Michelle. I'm Chief of Manufacturing.
Hi, I'm Evelyn. I'm the Chief of Marketing.
Hi, I'm Annabella Ducheneaux, and I'm Chief Technology Officer.
Our goal is to make informed annual decisions that prioritize maximizing cumulative total shareholder returns to keep our customers, shareholders, and employees happy. We aim to develop innovative products and providing exceptional service while also maintaining a strong financial performance and upholding ethical business practices. Next. First, we'll be discussing our strategy analysis and the information we used. Next. During our analysis and decision-making process, our team tailored decisions to a specific strategy for each market sector in the US, Europe, and China, taking into consideration the unique characteristics of each market and the specific needs and preferences of our target customers in each region. We heavily relied on 2 key sources of information: financial statements and market reports. We looked closely at the financial statements to gain insight into financial health and performance of our company, which included the feature costs, promotion, costs and expenses total, and profit for the round. By analyzing these points, we can assess the effectiveness of our product development, marketing strategies, and identify areas where cost savings can be made. It also showed us our strengths and weaknesses to make informed decisions and future investments and operational adjustments. Additionally, we consulted market reports to stay informed about the latest trends and developments in our industry, including selling price, number of features, sales, and demand. This helped us determine our pricing strategy and differentiate ourselves from our competitors to better meet the needs of our target customers. By leveraging these 2 sources of information, we were able to make informed decisions and develop effective strategies to achieve our goals. Next. Something else we took into consideration was the market outlook. We did not structure our entire strategy around this, but we noted a few things. In year 1, although Europe showed indications of growth decline, it had the largest market size, followed by the US and then China. In year 2, China experienced the most growth at 8 to 9%, while the US managed to remain at 5%. However, Europe will only see a 3% growth and might even witness a decline in European demand. In years 4 and 5, Europe continues declining while the US maintains a positive growth and China experiences a rapid growth. For years 6 and 7, interest in hydrogen and EV technologies increased, with China betting on EV technology and an increased demand for hydrogen vehicles in the US due to entrepreneurs that want to monetize the natural gas reserves in the country. Some extra sources of information we looked at was sustainability and HR reports. They were used to maintain staffing, cost, and the social responsibilities of our company. Now handing on to Joe for formulation.
Hi, in formulation, we're going to talk about the general goals and strategies we use in each year. Next. The general goals, we're focusing on gaining a leg in all 3 markets, US, China, and Europe. Gain a significant market share in each of these categories of vehicles that we're producing, have at least 12 features for combustion vehicles, gain sustainability and incorporate good ethics within the workplace, maximize cumulative total shareholder return, and the strategies we used would gradually reduce the long-term debt, utilize new technology, and compete with attractive prices and features. Next. In year 1, we started selling both combustion and hybrid to all 3 countries. This was in order to gain a significant market share within all of the countries. We choose contracts manufacturers with ethical and sustainable levels of 3 or higher. This was in order to avoid any sustainability issues later on. We built 1 factory in China to decrease the manufacturing costs. This helped us meet our goal of cost-effective vehicles in order to gain a larger profit margin. In year 2, we transferred money from US to China and transferred from Europe to US in order to cut into the long-term debt. We increased expected personnel hires, monthly wages, and training. This was in order to have a more efficient and motivated work environment. And we got licenses for electric, hydrogen, and new features for hybrid. This was to incorporate new technological features in our vehicles. Next. In year 3, we reevaluated our prices and market budget for US and Europe. This was to see how we're matching up with competitors' prices. Second, US production line, we swapped from hybrid to electric. This was to gain an edge within the electric vehicle market and closer to gaining a new feature in electric and hybrid. In year 4, we maintained the highest share in electric vehicles in order to hold a significant market advantage. We decreased market budget for all countries and products in order to cut down on production costs and expenses. This was to help lower our overall price estimates for our vehicles. And we decreased capital capacity allocation for all production up to 10% to switch the first production to hybrid. This was to lower capital capacity allocation in order to maintain inventory. Next. In year 5, we increased the amount of features available for hybrid, electric, and hydrogen. We invested in other factories for both countries. This was to help sustainability and production efficiency. And we issued stocks in order to make up any lost costs. This was to raise capital. And in year 6, we started selling hydrogen vehicles in order to get our feet into that market. We switched from combustion to hydrogen for U.S. production in order to achieve a more sustainable production line. We get new features for electric, hydrogen, and hybrid. In year 7, we bought back shares of stock, and we began to start paying out dividends to shareholders. We switched combustion production to electric production within Europe, and we get new features for electric, hydrogen, and hybrid. And now I'm going to pass it off to James for implementation.
Okay, so this is how we went about implementing our strategies. Next. Okay, for research and development, the plan was to get a new feature every year. We prioritized combustion, followed by hybrid, electricity, and finally hydrogen. The plan was to allocate an estimated amount of personnel needed to develop a new feature by the end of the year. We spread out the remaining personnel to each technology that was available at the time. As for the selling price, initially the plan was to gain sales by having our prices be lower than our competitors. In the later rounds, we started basing the selling price on other companies, specifically how many features were being marketed and the selling price of their market. Next. While the company's personal volunteer turnover, which was 6%, ended slightly higher than the market average, which is 5.6. The company had better layoffs, 0, compared to the market average of 3. Next. Now for finance, the main focus was paying off debt. Ensuring that there was no short-term debt at the end of the year was a huge focus. This was mainly achieved by transferring money around. For long-term debt, 1 million was spent on it for almost every year, with 1 year where we did not reduce long-term debt. During year 4, we felt like we needed to issue some stocks to help pay off the short-term debt. We issued stocks for year 4 and 5, then bought some back at year 6 and 7. Next. Production. In terms of production, we spent the first 3 years with capacity at 100% for both plants. During year 1, it was only combustion. Year 2, we produced both hybrid and combustion. Year 3, we started producing electric. Year 4, 30% capacity was used in US factories and 20% in Chinese factory, with the same things being produced as year 3, but with less capacity. Year 5 produced the same as the previous 2 rounds, but with 20% capacity used for both features. Next. Year 6 and 7 had US factories at 15% capacity, producing only hydrogen. Anyways, as you can see from the graph to your right, this decision led to a lot of excess inventory. Probably can divest in some production plants for a year or 2. Next. Marketing. Combustion was sold in all 3 countries for years 1 through 5, and only in China and Europe in the last 2 years. Hybrid was sold in every country only in year 2, then in China and Europe for years 3 to 5, and then only in Europe for year 6. Electric was sold only in the US for years 3 through 5, both US and China for year 6, and every country at year 7. Hydrogen was only sold in the US during year 6 through 7. At the end, the company's highest global technology shares were combustion and hybrid in combustion, with hybrid in second. Electric and hydrogen are rather small in comparison. Next. The company's final global market share during the 7 years is 6.99%, 6.96 for US, 9.06 for China, and 5.05 for Europe. Next. Here's a breakdown of each market share by technology. Globally, electric and hydrogen are the highest. In Europe, hybrid is 8.1%, while electric is completely ours at 100%. In the US, electric, we have majority market share at 57.71%, while hydrogen is 38.78%. In China, we have a small 12% in combustion and a slightly larger 20.61% for electric. Alrighty, now for governments with Annabelle.
In terms of strategy governance, next. Our main objective was to increase cumulative total shareholder return by adjusting decisions to impact market share, profits, and revenue. Next. We have every year broken down by market share globally and with each market, profit, sales revenue, and cumulative total shareholder return. These numbers informed how we would proceed into the next year. Let's take a look at how to proceed from year 1 into year 2. Next. In order to increase market share, we suggest increasing the number of vehicles produced in China to better meet demand. By ensuring that enough cars are being produced for consumers to buy, this can prevent our competitors from gaining market share from our unsatisfied demands. Also, it would be beneficial to increase the amount spent on marketing in order to persuade buyers to purchase our combustion and hybrid vehicles over the competition. We recommend an increase in prices for vehicles sold in Europe by 5% in order to increase revenue and overall profit. Europe is not a price-sensitive market, which allows more room to easily generate higher revenue. In general, it would be beneficial for lessening overall debt to transfer money from the US market to China and from the European market to the US. In this instance, we should transfer 12 million from the US to China and 20 million from Europe to the US. Additionally, it would be advantageous for our company to explore emerging markets. Buying licenses for new electric hydrogen vehicles, as well as buying new features for our hybrid vehicles, would provide us with a head start on sustainable energy compared to our competition. Next. This is our breakdown of year 2. Next. So moving on to the next year, as we began to see the combustion market become oversaturated, our market share declined and we focused more attention on sustainable energy. To improve market share for year 3, we switched from hybrid to electric vehicles in US production line 2 to gain market share in an emerging market. Again, we also recommend increasing spending on marketing in most categories to persuade buyers to purchase the available vehicles. We also suggest adjusting various vehicle prices in each market to better reflect the current market rates, along with allowing us to increase the number of features available for each vehicle type. Next. This is our year 3 breakdown. Next. Going into year 4, we decreased marketing budgets for all regions and product lines to reduce overall spending costs. This would improve our overall profit margin as there would be less expenses to pay for. We recommend issuing stocks to raise capital from investors without taking on any more debt for the next year. Furthermore, decreasing capacity allocation for all production lines down to 10% helps reduce overall spending and limit overproduction. By doing these adjustments, it saves the company millions in spending costs. With this savings, we bought new features for multiple vehicle types and switched US production line 1 from combustion to hybrid to gain a competitive advantage on overall vehicle technology. Next. For year 4, our company had the majority market share in US electric vehicles. Next. When proceeding into year 5, we wanted to focus on translating that success into other avenues. We can increase the number of features available on all vehicle types by 1 to ultimately increase the value of the cars in the minds of the consumers, making the price increase worth it. Again, we issued stocks to raise capital without taking on any more debt, and adjusting overall vehicle prices would provide us with higher revenues. This savings would again allow us to buy new features for our vehicles and maintain our competitive advantage within sustainable energy. Next. This is our year 5 breakdown. Next. For the next year, we suggest major changes within US and Chinese production. For US production 1, we believe switching from combustion to hydrogen vehicles would allow us to fully place ourselves in the sustainable emerging market. For China production line 2, we believe switching from hybrid to electric vehicles would also be beneficial. Again, purchasing new features and licenses would allow us to maintain our competitive advantage with the markets we are serving. By switching US production line 2 from electric to hydrogen, our company ensures an advantage over vehicle technology. This further grants us the ability to leverage and maintain our position in the emerging sustainable market. Next. This is our year 6 breakdown. Next. Lastly, going into year 7, we recommend a switch from combustion to electric vehicles in Europe production line 1. This will provide us with market share in all 3 markets, emerging sustainable vehicle industries. By buying more features for multiple vehicle types, we solidify our standing in the world of sustainable vehicle technology. It would be advantageous for Bull Automotive Inc. to buy back shares to improve overall return on equity and return on assets. Also, paying dividends signals current and potential investors that the company is stable and would provide returns on their investments. This would ultimately lead more investors to our company and increase overall price per share. Next. This is our year 7 breakdown, and as you can see, our cumulative total share return dropped to 11.2%. Next slide. Although the CTSR declined from year 1 at 60.22% to year 7 at 11.2%, we are confident that this is not a cause for concern, but rather a reminder that we pivoted our production away from combustion, which was an overly saturated market, towards renewable energy like electric and hydrogen, which are still emerging markets. In terms of global numbers, we have the highest market share for electric vehicles and the second highest for hydrogen vehicles. In Europe alone, we have 100% market share for electric vehicles. In China, we have 20.61% market share for electric vehicles, and hydrogen is a completely untapped market that we have the potential to gain 100% market share in. In the US, we have a majority market share for electric vehicles at 57.71% and 38.78% for hydrogen vehicles. Overall, as the renewable energy markets become more popular among consumers, Bull Automotive Inc. has the potential to increase CTSR back to its original place or higher. Now to Michelle for the strategy forecast.
Thank you. So for the forecast, I'm first going to look more into the thought process that we were all looking through. So as the team has mentioned, thought process in terms of guidance, we did look at all 3 markets, making sure we implemented a certain amount in all locations. We did focus on hybrid and combustion as we added more demand to be sold. And by switching it to electric and hydrogen, that made the company's goal more sustainability, which was the main thing for the company to do. But the company has made a significant amount of inventory, which then cost the company more in its loan debt. The loan debt increased, and that led to the company to prioritize the debt in order to keep producing more vehicles. The loan debt was the next major issue only because we had to switch their goals instead of making more production, which had to focus their attention to getting rid of it. And the electric and hydrogen switch, as I have previously mentioned, as well as the group has, could have been implemented more into Europe. And lastly, the drop in combustion, if we had to move the company into more a sustainable route, dropping combustion completely would have made that outcome a little bit more easier. So in conclusion, we did rank 7th out of 9 with the 11.20 cumulative total shareholder return. For our team, this is for our revenue. And this is for our cumulative total shareholder for all the rounds. And that will be the end of our presentation.